Welcome back to the channel, everybody. I am Rocky Ryan. Today's video is for entertainment purposes only. I'm going to be talking about a stock that has absolutely cratered recently. I do think that it is a bit of an overreaction. I'm going to explain why. I'm also going to value the stock for you, so stick around because you're going to want to see what my model values the stock at. I'm doing research for you. All I ask in return is you hit that like button. So with that being said, let's dive on in. So the stock that I'm going to be talking about is CBS Viacom. The stock had a major run up and today it had a 27% drop. In fact, it has dropped 50% from its recent high. So, should you sell the stock? Should you buy the stock? What is going on? Let me break it down for you. CBS Viacom had a major run up in the stock because it is focusing on getting into the streaming business. That is a very smart thing to do. And in order to get into the streaming business, the company is having to spend a lot of money on capital expenditures, meaning reinvesting into the company in order to build out this product. So today and recently, the stock has been hammered because of rumors and news, which is now confirmed, that the company is raising money by selling shares to the public in order to get capital in order to fund this business. Generally, that's a common thing that happens when a stock is looking to grow. They will sell shares to the public in order to raise money. But it is also worth noting that beyond the fact that the company is diluting their shares by selling more shares and thus making the share price technically not worth as much, there is a massive amount of short interest. So there's a bunch of people that are already shorting the stock, and then when this news came out, it created this perfect storm to where all the bears were able to basically pound and get the stock to go down further. Taking a look here at Morningstar, there's 102 million shares short, which is 18% of the float on the stock. The short ratio is 5.22. So essentially, there are a lot of people who are betting against CBS Viacom, and then thus the stock has been depressed because of all of the shorting. But if you own shares of the stock, I understand that it's painful and that the fact that the stock has dropped a lot recently, but before you go and sell or panic, let me show you what my model is valuing the stock at. Okay, so I pulled up my discounted cash flow model here, which if you've seen in my previous videos, this is how I value stocks. And so what we're looking at here is going to be the financials from Morningstar for CBS Viacom. And when I look at this, I first of all always look at the free cash flow per share. Free cash flow per share has been positive over the past 10 years. If you go look at other companies like Netflix, they actually have negative free cash flow per share. And so the fact that they have free cash flow per share that is positive is already a good sign. So the next thing that I like to do is take a look at shares. Shares were decreasing from 2011 all the way until 2016. And so what you see from this is that the free cash flow per share was steadily increasing, as it should, because as there's less shares, there's going to be more free cash flow per share. Recently, the stock has been getting diluted and they've been selling more shares because they've definitely had a plan to get into streaming for quite some time. So what has happened is it has affected the free cash flow per share. The free cash flow per share was 4.06 in 2016 and now it is at 2.9 in 2020. That's not necessarily a bad thing. It's actually expected when your company is spending more in the business. And the way that I know that they're spending more in the business is because I look at the capital spending and I see here that it was getting lower and lower, but recently they more than doubled it in 2019 and 2020. So everything makes sense about what's going on here. They're investing into streaming. Next, when I run my model, I take year 2020 free cash flow per share, I go back 5 years, I take the free cash flow per share from there, and it gives me a compound annual growth rate. That is what is going on right here. So I'm going to run 3 scenarios and show you the different scenarios in which my model valued the stock at. So since I'm running 3 different scenarios, these numbers don't change. The next part of my model is projecting out a future growth rate. Generally, I like to take out a future growth rate that's similar or close to the previous compounded annual growth rate. So let's just go with 2% because in the past, the free cash flow per share was growing at a higher rate because the company wasn't spending so much investing into the business. So I'm going to go with something like 2% because I do think that streaming is going to end up paying off for this company. The discount rate that I'm going to use is 7.5% because you have to discount the stock back to a present value. 7.5% is the annualized return on the S&P 500 adjusted for inflation. Next, I'm going to do a 3% GDP because you have to assume that the economy is going to grow at a certain rate. And that gives me an intrinsic value of 59.7. So my model is saying that this stock today is worth $59 per share. So now let's look at what the share price of CVS Viacom is today. So here we see the stock is at $48.23. So then I go back to my model and I enter $48.23, and that gives you an upside of 23%. So theoretically, this stock is actually undervalued by 23%. The stock was all the way up like at 90 and it has lost 50% in value. But truly, the real value of the stock is $59.70 according to my model. And I'm using data. I'm not just coming up with some number in the sky where I think, oh, it's worth this much. This is a model that is used by Warren Buffett. This is the model that Warren Buffett uses when he values the stock. He uses the free cash flow per share discounted cash flow model. So now we're going to run the next scenario. The next scenario is if you're a little bit more bullish on the company with its streaming, which I am. That makes sense. They've been investing into the business. We're going to use a 3% future growth rate, which is not even that high. We're going to use a 7.5% discount rate. We're going to use a 3% GDP rate, and that gives you an intrinsic value of $62.50. Currently trading at $48.23. That means there's 29% upside from the current price. So before you go and panic, just wait a second. My model is telling you that it's worth $59 per share. My model is telling you that it's worth $62 per share. So we're going to run our last scenario here. So now if we're a little bit more bullish and we go with a future growth rate of 5%, and let's say we discount it at an even higher rate. Let's go with 8%. We're going to go with 3% GDP rate. Then it's saying that the stock is worth 60.97, trading at 48.23. This model is telling me that under my three scenarios, this stock has 23 to 29% upside. Also, it is a stock that's heavily shorted. So if momentum swings back, or maybe, Wall Street bets or a bunch of people get involved where they start buying this stock again, we might see a short squeeze. And beyond that, the stock pays a 1.99% dividend. So at the end of the day, regardless of whether the share is going up or down, you're still getting a dividend. I actually like CVS Viacom after I've been doing this research. Full disclosure, I don't own any shares of it, but this makes me think that that is a huge overreaction by the market, and if you own shares, then maybe you shouldn't panic and sell. In fact, maybe you should buy more on this dip. As always, if you enjoyed this video today, make sure to hit the like button as well as subscribe. I really appreciate you guys being here. You can even share it to your friends if you'd like. Thank you. I'll see you again soon.